Famous last words. Hopefully it is smooth. Welcome to our session on employee stock ownership plans. Melissa Bizyak, that's me on your screen. That was me on your screen probably 10 years ago. My co-presenter, senior manager in the Valuation group, is Brad Matthews. So we thought employee ownership in the form of employee stock ownership plans would be a great topic. We've talked about exit planning during our prior CPE days, and we have briefly mentioned the option of employee ownership. Well, this year, our group has worked on a number of transactions related to ESOPs. We have developed over the last dozen years a pretty robust portfolio of employee stock ownership plans that are required to be valued annually, and I'll go into that in a little bit. But we just thought today would be a great topic due to a lot of circumstances that I want to introduce to you in a minute here that bring to light the advantages of employee ownership in the form of an ESOP, if it fits and it's right for your company. So why now? Why not? A lot of tax changes that may be coming down the pike, talking about tax rates increasing for corporations, pass-through entities, capital gains taxes. There are a lot of tax revisions that will be coming down the pike that lend themselves to making ESOPs more attractive. President Biden had appointed and confirmed a number of ESOP proponents, namely Marty Walsh, who is the U.S. Secretary of Labor, Isabel Guzman, who is now the head of the SBA, as well as a gentleman by the name of Jared Bernstein. And he was appointed as a member of the President's Council of Economic Affairs. What's interesting about Mr. Bernstein is that he wrote a white paper that was titled, and I want to make sure I get this correct, that was titled, "Why Aren't There More? Assessing the Barriers to ESOP Creation." Mr. Bernstein has been a big advocate of ESOPs in very different avenues over the years, but this particular white paper that we have on our website and a link directly to the white paper provides a lot of information as to what the perceived barriers are with respect to employee stock ownership plans. Another reason why I want to talk about it is it is a viable exit planning strategy if it fits. Brad will talk a little bit later today on the idea of feasibility. It's not a situation where, like any exit plan, where we're going to enter this situation lightly with our clients. We want to make sure that there's a vetting process and certainly ensure that an employee ownership plan is right for the client. So first off, what is an employee stock ownership plan? Well, one thing that it's not a stock option plan. I have had to clear that misconception probably with most clients that I speak to. First off, they think it is a stock option plan. It is not. An ESOP is actually a qualified retirement plan under the Internal Revenue Code Section 401A. An ESOP invests primarily in the stock of the companies that adopt and sponsor them. ESOPs are governed by ERISA, which is the Employee Retirement Income Security Act of 1974, and the Internal Revenue Code. It's regulated by the Department of Labor under ERISA and the IRS pursuant to the Internal Revenue Code. An employee stock ownership plan is a plan wherein employees of a company will share in the capital appreciation of the company. Some ESOP facts, just briefly, and I compiled these from the National Center for Employee Ownership. See, this is not smooth, Mary Lou. This is me. Sorry. There are roughly, it says 6,600, but I checked this morning, it's 6,501 ESOPs covering more than 14 million participants nationally. 2/3 of ESOPs are used to provide a market for shares of a departing owner. equity owners of a business. So it is a viable exit planning strategy. Less than 10% of plans are in public companies, and 55% of ESOPs are in S corporations. And I'm going to talk a little bit about S corporations and the enormous tax advantages that are availed to ESOPs that are either partially or entirely owned by an S corporation, or S corporations that are entirely owned by an ESOP. Industries that ESOP sponsors or ESOP sponsor companies are participating in: manufacturing, 22%, professional, technical, 19%, finance, insurance, real estate, 15%, and then construction industry, 13%. I'd have to say our portfolio of ESOPs as it stands today is a pretty healthy mix. We started out pretty heavy in manufacturing and migrated to more professional services, technology businesses. So pretty much a nice mix spanning a number of industries. And I did it again. Sorry, Emma. So topics that we're going to cover this morning, or this afternoon, sorry, would be ESOP history. We're going to talk about the roots of employee stock ownership plans. We'll talk about misconceptions, which there are many, benefits, and certainly alternatives to an employee stock ownership plan as we talk about exit planning. Vetting an ESOP, very important. We'll talk about feasibility of an employee stock ownership plan. Repurchase obligation, liability, and this is something that is tossed around a lot when we first start talking about employee stock ownership plans and whether or not they're feasible. We'll talk about the basic leveraged ESOP transaction, walk you through the structure of a typical transaction, and then we'll talk about tax considerations. Obviously, a lot of benefits to employee stock ownership, and the tax considerations that are on the part of the exiting shareholder, the company itself, as well as the employees. And then we'll wrap things up talking about valuation considerations in looking at ESOP transactions as well as the ongoing ESOP valuations. Here is the first poll. Describe, please, your familiarity with employee stock ownership plans. Just to go over, and I'm going to advance the slide in a minute here, talking about history of ESOPs, I think it's important for us to add this section because I feel like a lot of the misconceptions that Brad is going to go through in a few minutes here really deal with the history of ESOPs. So am I allowed to advance? You guys can yell at me. So 62% of you guys have been introduced but have no personal experience. So great. So we'll give you a little bit more than a primer this morning, or this afternoon. Oh my gosh, Melissa. So ESOP history. There was an attorney and an economist by the name of Louis Kelso that technically created the first ESOP in 1956 as a means to transition ownership from the owners of Peninsula newspaper to their chosen successors. That would be their managers and their employees. There have been employee ownership through other allowable vehicles since 1921. However, the concept that, as it stands today, was first created in 1956. So in looking at transitioning ownership from the founders of the newspaper to their successors, the first hurdle and the biggest hurdle obviously was, how do the employees afford to purchase the business from the two founders? How do they use after-tax dollars to fund the purchase? One of the things that Kelso observed was that over the years, the management of the newspaper was funding its retirement plan annually. They were making annual contributions. So one of the things, light bulb went on, one of the things he noted that, well, instead of having the company borrow the funds and repay with after-tax dollars, why wouldn't the company's profit-sharing plan borrow the funds and repay both principal and interest out of the annual contributions that the company was already making to the plan? Net effect of this was to repay both principal and interest with pre-tax dollars. Now, at that time in 1956, there was nothing in the Internal Revenue Code that authorized leveraging of an IRS tax qualified retirement plan. There was an exemption, however. The exemption was that the transaction had to be at arm's length and thus at more of a fair market value and in the best interest of the plan participants. So after some narrative coming from Kelso, he actually got that approved through the IRS and was enacted the exemption. So at that point, Kelso originated the strategy of using IRS tax qualified plan as a tool for succession. Over the next 25 years, the newspaper thrived. It paid out millions of dollars to its participants, and then eventually there was a sale transaction to a larger conglomerate for millions of dollars. Thereafter, in 1984, Senator Russell Long was also a catalyst for ESOPs by enacting 4 provisions that are included in the were included in the Tax Reform Act of 1984 that related to ESOPs. 2 of them have since stuck, but 2 others have fallen off. One of the notable provisions that fell off was to allow those banking institutions that provided funding for employee stock ownership plan buyouts to recognize their interest on a tax-free basis. The concept of an ESOP as we know it now was signed into law in 1974 when the Senate passed its version of ERISA. Now, what ensued, I think, in the intervening years to current times is, I think, certain events and certain situations that have resulted in ESOPs, getting more of a bad rap. So, namely, in 1979, ESOPs were used to save failing companies, wherein employees were given stock in their companies that they worked for in exchange for negotiated salary reductions. So in this area, geographic area, the one company that always comes up when we're talking about ESOPs is, well, Weirton Steel didn't make it. But also in that bucket was Chrysler Corporation and United Airlines. So not an ideal situation for an ESOP, not really what it was intended for. The companies were already failing. And so, trying to bring in an ESOP to save those companies. Also from the 1970s to the 1990s, ESOPs were used to facilitate divestitures. And divestitures, following the recession of 1974, divestitures in publicly traded companies, either divisions or subsidiaries, to raise cash and to rid themselves of non-profitable lines of business. Defend against hostile takeovers. Believe it or not, I believe that Polaroid is the poster child for the defense against hostile takeovers, wherein a competitor would come into a company and buy up some of their stock and then force a buyback of the company at a premium. ESOPs were in fact used to gain 20 to 30% of the company in order to prevent that type of proxy voting. And then lastly, going private transactions, the early 80s led to situations where publicly traded companies sought to go private. They teamed up with private equity groups. They needed, additional debt was incurred. Obviously, this is a costly transaction. ESOPs were used to also facilitate and subsidize some of that debt. So, as you can see, over time, ESOPs kind of took a little bit of a curve and got away from what they were originally intended to do. And what they were intended to do back in 1956 was to succeed, a succession tool for owners of companies to pass along their businesses to their employees. So with that little bit of a history, I'm going to turn things over to Brad to talk about some of the benefits and misconceptions of ESOPs.
Thank you, and good afternoon to everybody. To continue to kind of lay the groundwork, the background behind the ESOPs, we are going to talk about some misconceptions and some benefits to these plans themselves. Now, I'm not going to touch on every one of these misconceptions, but keep in mind as you go through the bullet points, every one of these is false. It is a misconception, so don't read this the wrong way. But I want to highlight some of the ones that we routinely see when we're in the marketplace in this space as it relates to ESOPs. And the first one that I want to highlight is that the selling shareholder must sell 100% of his or her stock. And there is no rule in terms of the amount of stock that needs to be sold into an ESOP. We work with ESOPs that range anywhere from companies that are 100% owned by an ESOP to less than 5% owned to an ESOP. So there is no rule. Melissa will talk a little bit about the tax strategies and how there may be a minimum amount that you might want to sell whenever you're setting up these plans to qualify for certain tax strategies, but it does not need to be 100%. In fact, a lot of companies that do staged transactions where tranches of the ownership are sold to the ESOP actually lessens the burden upon the sponsoring company in terms of having to service the debt associated with these ESOP transactions. So it's definitely a strategy, and it depends on the circumstances of what the seller wants and what the business can afford to do. Another one, the selling stock to an ESOP results in loss of control by an owner. Also false, one of the ways that these can be structured is that owners can retain control of the business post-ESOP transaction. So part of the vetting process of an ESOP is to lay out what are the goals of the selling shareholder, what are the requirements of the ESOP, and if a selling shareholder does want to retain control, that's absolutely something that can be structured into these plans. Another one that we see can only be established for a C corporation. Some of the most successful ESOPs that we work with are 100% ESOP-owned S corporations. And if you think about it, S corporation is not burdened by any federal income tax at the corporate level. Well, the ESOP also qualifies as a tax-exempt plan. So as the shareholder, 100% shareholder of an S corporation, the ESOP doesn't pay any federal income taxes either. So you have a company that is completely exempt from paying federal income taxes, can create some significant cash flow strategies. Some other misconceptions that we usually see: must be 100% invested in the shares of the sponsor company. While generally it's required that it's primarily invested in the sponsor company stock, it doesn't have to be 100%. There can be other investments that can be cash sitting in these participant accounts. Another one, ESOP makes sales difficult to a third party in the future. We are actually currently working with one of our ESOP clients wherein the operating business was sold to a third party. And what was interesting about this ESOP transaction and selling of the operating entity was it was sold to a third party that competes in the same space as the sponsoring company. And the buyer actually owned a number of different companies in this space and was willing to pay significant premium for the business. So now we're in the process of winding down the ESOP. The ESOP no longer owns the operating entity, but the shareholders, the employee shareholders, have seen a tremendous benefit, primarily in that difference between the fair market value of their shares and what the company was actually able to be sold for. And then the last one that I want to point out here, creates a repurchase liability that may harm the future of the company. We'll get into repurchase obligation liability a little bit more in detail. It does create a liability. Establishing these plans, it does create future cash outflow burden upon the sponsor company. However, these repurchase obligations are definitely things that can be managed over time. There are specific companies that specialize in quantifying that repurchase obligation liability and allowing for management to properly plan for dealing with that liability over a period of time. So now looking at the benefits of an ESOP, specifically to the selling shareholders, the first two are really interrelated. Provides a ready market to sell the shares at fair market value, and it's an effective means for exiting the company for the controlling shareholder. Really what we're getting at here is the sale to an ESOP creates a market for a business that you generally don't get to see with a privately held business. So it does create that market to allow an exit strategy for that selling shareholder. Creates significant tax benefits for selling shareholders. As Melissa will talk about, it could potentially be a tax-free sale. So whenever you're comparing a sale of a business to an ESOP versus a sale to an otherwise equivalent third party, there can be significant tax benefits, significant benefits to the bottom line in terms of what that selling shareholder can put in his pocket, his or her pocket. It also allows for the selling shareholders to retain voting control. Again, if that's something that's important for a selling shareholder, these plans can absolutely be structured so that post-ESOP transaction, the control remains with that selling shareholder. Some benefits to the company. It's an effective means for succession and continuity in the management team. So when you think about an ESOP transaction, nothing really changes operationally day to day with the company. The goal can absolutely be for management to stay in place into the long-term future. Whenever you think about a sale to a third party or even sale to venture capital, that management team may not remain in place post a transaction. So it's a way for the company to make that continuity a part of the plan. There's incentive for recruiting and retaining employees, and it's a way to increase employee morale. It really has a significant impact on company culture in general. So it aligns the goals of the employees with goals of owners of a business. At the end of the day, it's going to be to increase the value of the business, meaning increase revenue, decrease expenses, decrease risk, all of which will, over the long term, benefit those employee shareholders by way of their retirement accounts. And then last that I'll touch on here, reduction of corporate taxes, significant increase in cash flow. Again, we see clients that are 100% ESOP-owned S corporations experience significant cash flow impacts as a result of the ESOP transaction. Benefits to the employees, primarily, unlike a traditional 401k or a traditional retirement plan, where an employee would need to elect to have their paycheck reduced in order to contribute to their retirement plan, employees acquire that beneficial ownership interest in the company without having to invest their own money. Now, kind of along with that, they're able to acquire that stock without paying tax on it immediately, and they also benefit in the growth of that ownership or the growth of those shares until the point of distribution, at which time they would pay tax on that distribution, that liquidity event. And then the last two, again, interrelated. Employees share in the current and future economic rewards of the ownership, and it builds loyalty and motivates performance. Again, what it's doing is aligning the goals of the employees with goals of ownership of the business, and that is to increase the value of the business over time. So as we start to think about vetting through an ESOP, an important first step in establishing one is determining feasibility. Now, when we talk about determining feasibility, what this is attempting to do is identify if there are any discernible risks to the sponsor company or to the plan in establishing and administering the ESOP itself. So it is going to provide an analysis of an impact to the sponsor company. And primarily what these studies are going to look at is the ability of that sponsor company to service the debt requirements that are related to the ESOP transaction. So as you'll see, as we'll illustrate, as we talk about kind of the basics of these ESOP transactions, the sponsor company actually will go out and secure the loan that is necessary to buy out the selling shareholder. So the ability of that sponsor company to service the debt related to the purchase price from the ESOP is critical and a focus of these kind of studies. So the primary aspects of these study, first and foremost, is going to be a preliminary evaluation of the company. So understanding what the expectation is in terms of what the ESOP is going to need, what the company is going to need to borrow, and what the ESOP is going to need to raise in order to buy the shares from that selling shareholder. The second is going to be, what is the ability of that sponsor company to acquire and service that debt in ongoing operations with the company? Now, understand that these studies themselves extremely complex and they're very fluid. So the plan design of these ESOPs is very dependent on a number of things, one of which is going to be the purchase price. The purchase price and ability of the company to service the related debt is also dependent on the plan design. So these types of studies are very fluid in nature and kind of ongoing as the background administration is set up on the front end. Now, it's also going to involve, again, we'll talk about that repurchase obligation liability, but the impact of that liability on the sponsor company as it continues post-ESOP transaction. Now, when we think about this feasibility study, one of the things that we always point out is we really strongly advise that the sponsor company hires a company that specializes in this type of feasibility analysis. The formality of these studies can vary. However, there's a significant amount of unique complexities that must be considered in these studies and in the plan design. And again, it's an analysis that needs to be updated as more and more things are determined in terms of the design, the plan design itself. Now, because the feasibility is a critical piece in this formation of this, is because it really identifies on the front end if there are going to be any significant issues that need to be addressed, whether it be in plan design, amount of ownership that the ESOP is going to acquire in the business, those kind of things. But it is truly a critical first piece to embarking down the ESOP trail. So we're going to pull up another poll question, alert poll question. This one is going to be, how do we feel about these virtual conferences? So we, as a group, have put on a number of these. We did a 5-part series that I do see some familiar names in the attendee list. But we wanted to gauge interest on how everybody feels about attending virtual events as opposed to in-person events. I personally do miss seeing everybody at CPE Day, and I'm not going to turn down a free lunch either. All right, with that, I'm going to take a look at the results. Prefer in person, but virtual is convenient. I would absolutely agree with that. Few people never leaving their house again. I also can understand that position as well. All right, so we're going to take a look at, and mentioned it a few times, this repurchase obligation liability. And really, what this stems from is the idea that ESOPs are unique in the fact that, unlike a 401k that holds shares of public stock, a privately held business, like an ESOP, is like most ESOPs, it does not have that readily liquid market. There's not the ability to turn that ownership into cash on a quick basis. So to facilitate this liquidity, the Internal Revenue Code, Treasury regulations, DOL regulations provide for the ability for participants to put their shares back to the company upon meeting certain triggering events and vesting requirements. So upon meeting those types of requirements, they can require that the company buy their shares back from them at fair market value. So what this does is it creates a future cash outflow borne upon the sponsor company. That right to sell is guaranteed to the participant, but not required. They can elect to do it upon meeting those requirements. They can also provide an opportunity for participants to diversify. Again, if they meet certain requirements, generally, you can diversify, meaning you can turn your ownership, you can require the company buy your shares and convert that ownership of the sponsor company into a more traditional retirement account. So what these put and diversity rules really create is future cash outflow obligations to the sponsor company. So at a certain time, that sponsor company is going to be required to fund these repurchases with operating cash flow. So the obligation itself, in terms of how it is quantifiably measured, is that present value of all of those future payments that are a result of those put and diversity rules. So it is considered an off-balance sheet liability. You won't see it whenever the financial statements come out. It's a contingent liability, and it's going to change over time. As the business grows, that repurchase obligation liability is going to change along with the change in value of the business. Now, the sponsor company must consider the future cash flow requirements and the impact on the company's performance. And again, as I said before, there are companies that you can hire that specifically take a look at and project when this obligation may become due and the magnitude of the obligation. Now, the magnitude fluctuates for a variety of reasons. First and foremost, it's going to be dependent on the sponsor company's employee census. And when we say census in this regard, we mean tenure of employees, the age of the employees, the turnover rate of the business. Also impacted by the size and timing of repurchases and distributions. And that is really going to be dependent on two different things. What is the fair market value of the shares that the participants have in their accounts? And again, that's going to change over time as the business grows. Presumably their share value is going to grow as well. But it's also impacted by specific plan attributes. That is, the vesting attributes, redemption attributes, the diversification language inside these plan documents. All of those things are going to have an impact on the projected trigger dates. The projected trigger dates, we have to figure out what is the expected value of the shares at those dates, and then how many shares do each participant own. Bring all of that future buyouts back to present value gets us to the repurchase, the magnitude of the repurchase obligation liability. So quickly, we're going to go over a basic leverage transaction where a plan is going to acquire a sponsor company stock and hold it in the trust on behalf of the participants. Now, these transactions are heavily scrutinized by the DOL, acting on behalf of the employee participants. The DOL requires that the plan does not overpay for the stock. The reason being, the plan overpaying for the stock is going to be to the detriment of the company. That's going to be to the detriment of the owners, which is to the detriment of the employee participants. So the DOL heavily scrutinizes these transactions. There's a lot of advisors involved with these transactions. From the seller side, seller retains legal counsel. A third-party administration firm does the ongoing administration of the plan. And the shareholder financial advisor is really the right-hand person to the selling shareholder in terms of negotiations, understanding structure, walking them through the process. From the buy side, in terms of the ESOP side, a trustee is hired to negotiate the purchase on behalf of the ESOP. There's a trustee council which really quarterbacks the plan document and review, the plan document formation and review, and the ESOP financial advisor, which is where Melissa and I fit into the fold. The financial advisor valuation professional is going to determine the market value of the block of stock that the ESOP is going to acquire, going to determine whether or not the transaction is fair to the plan, and is also going to take a look at the sponsor company's ability to service the debt related to the transaction. The plan sponsor, first and foremost, is going to set up a trust. That ESOP trust is going to be what purchases and holds that stock on behalf of the employee participants. That trust, the sponsor hires a trustee to negotiate on behalf of that trust. It can be an individual institution. Again, it can purchase 100% or a portion of the outstanding stock, depending on the goals of the selling shareholder as well as the feasibility of the transaction to that sponsor company. And we'll talk about standard of value in a little bit, and we've already mentioned it, but a critical piece of this is that the plan cannot pay more than what they determine to be adequate consideration, the market value of the shares of stock. Again, overpaying being to the detriment of the employees, to the detriment of the sponsor company itself. Now, the financing for these transactions is going to come from an external loan. So the sponsor company will go to the bank, secure a loan to be able to purchase the shares from the selling shareholder. The company then loans these funds to the ESOP itself so that the ESOP has the ability to purchase the shares from the selling shareholder. What this does is it creates what's called an internal loan, a loan between the sponsor company and the ESOP. That internal loan is designed to be repaid through deductible contributions to the ESOP and dividends. So the same way that an employer generally will make contributions to a retirement plan on behalf of its employees, those contributions to the ESOP now are what provide the ESOP with cash available to repay that internal loan over time. Also, any dividends that are declared are another way to move money from the sponsor company into the ESOP itself. Now, participants are allocated shares annually as that internal loan is repaid. So as the plan has the ability to pay off those shares, they're released from suspension and allocated to participant accounts. They're subject to vesting requirements. Employees are given options to diversify, and there are various options for distributions. All of these are set up in the plan documents as the plan is being set up on the front end, and another thing that needs to align with the goals of both the plan and the selling shareholders. So just to create a visual of how this works, the sponsor corporation in the top left here goes to the lending institution on the bottom left, secures that outside loan, takes that loan, and then sends it to the ESOP in exchange for that inside loan that will be repaid over time. That corporation then has the ability to buy the shares of stock from the selling shareholder and then will hold those shares in the trust to the benefit of the participants. Over time, that inside loan is repaid based off of those contributions that the sponsor is going to make to the retirement plan. So with that, we're going to launch another poll question. With this one, again, related to in-person CPE Day. What do you miss most about our in-person CPE Day down at South Point? Who knows what the future holds for us next year, but answers are it's always a good excuse to get out of the office, like seeing friends and colleagues. It's nice to interact with the GYF personnel, and of course those warm chocolate chip cookies.
How are you advancing? Which one?
All right, I'm going to pass it over. I'm going to show the poll results, and then I'm going to pass it over to Melissa to talk a little bit about the tax considerations.
I missed the cookies too, just so you know. I'm going to try to keep this at a high level. We can get into the weeds a lot when you talk about tax considerations in conjunction with ESOPs. Also note that tax considerations can slightly differ when we're talking about an S corporation versus a C corporation. So that's why we're going to keep it at a pretty high level here. So benefits to the shareholder, the exiting shareholder, or the owner that plans on staying around to ensure continuing success of the company. They can sell any percentage of the company to the ESOP, which needs to be at adequate consideration. And Brad will talk about that in a minute here when we talk about the valuation in connection with an ESOP transaction. But the magical threshold that everybody talks about is that tax deferral on an ESOP when the ESOP owns initially 30% of the company. That company has to be a C corporation at the time of the transaction in order to get that 30%, or in order to get that preferential treatment in deferring the gain under Internal Revenue Code Section 1042 after purchasing 30%. Very often in a C corporation, we see an initial tranche of 30% being purchased, and then over a certain period of time, through what we would call a stage transaction, the employee stock ownership plan gains control of the company. And typically, actually, what we see happening down the line is that the company then will elect S corporation status. And as I had noted and Brad had spoke to, once an S corporation holds the stock of an employee stock ownership plan, there's no tax being paid in that instance. With respect to the preferential treatment to defer the gain indefinitely, the selling shareholder must take the proceeds and invest in what's called qualified domestic replacement securities. And basically, the under 1042, the IRS lays out the type of investments that the proceeds must be invested in to qualify for the deferral. And there are a lot of, there are a lot of institutions out there that understand what this qualified domestic replacement security investments have to be in. So, it's not a situation where, you're looking very much for what these securities are. And a lot of them are, S&P 500 companies stock. Benefits to shareholders. If you're doing that stage transaction, initially selling 30% or a smaller position in the company, the shareholder can maintain control of the company and also maintain continued equity in the company over time. Transition that equity outside of the company or outside of the individual shareholder. The one thing that Brad will talk about in these staged transactions that must be considered is, for valuation purposes, purchasing a minority interest, there would be discounts associated with that. So, definitely purchase price and what the selling shareholder is contemplating should be vetted through in that feasibility process. The shareholder can and should continue receiving a salary to be involved in the management of the company. The selling shareholder will receive a greater investment income, so because no tax will be paid and more will be invested, more proceeds will be invested. And then immediately that shareholder will receive a more or achieve a more diversified portfolio. Couple things, we always hear this idea of an employee stock ownership trust. What happens is the company will establish an employee stock ownership trust, or an ESOP, along with the ESOP, which is a qualified defined contribution employee benefit plan. The ESOP, the trust itself, will hold the shares of the company stock as a beneficial owner for the employee's retirement accounts. So employees will not, one of the misconceptions, employees think that they will be, in fact, holding stock of the company. They actually have a retirement account within the ESOP trust to where they will be allocated shares over time. Diversification will be allowed for employees as they achieve an age of 57 and a half and a certain term of employment with the company. Now, tax benefits to the company, and this is where, if you guys have any questions, I'm happy to entertain calls, emails. I can walk you through how this works. But there are a lot of tax benefits to the company. When you think about an ESOP or a transaction, debt principal payments are never deductible in a transaction of the company's stock, with the exception of an employee stock ownership plan. So in the illustration that Brad was just showing, XYZ Corp can take federal and PA corporate tax deductions for both the interest and the principal payments made on the loans borrowed to fund the purchase of shareholder A shares, because they're in the form of retirement contributions. So these annual retirement contributions within certain limits, and it's for S&C corporations, it'll be 25% of qualified payroll, will be deducted, fully tax deductible. Cash contributions to the plan are also deductible. Dividends paid on cash on shares held by the ESOP can be tax deductible by the sponsoring corporation. There are some limitations there, but certainly that is a benefit, a tax benefit to the company. Cash dividends that are passed through to ESOP employee participants are also tax deductible for the company. ESOPs, as we had mentioned a few times, ESOPs do qualify as shareholders in an S corporation. As such, in that S corporation, that percentage ownership that's held by the ESOP is not subject to income tax at the federal level. Briefly, tax benefits to employees. Employees will acquire a beneficial ownership in the company without having to invest any of their own money. Employees are able to acquire ESOP stock without paying current income tax on the stock, but growth of the employee's interests will not be subject to tax until distribution. So no tax paid on behalf of the employee until a distribution is made. Obviously, employees will share in the current and future economic rewards of the company ownership. And this is where we see employees being incentivized, retaining employees, attracting employees to companies when that's needed because they have these advantages. Just keep in mind that there are different attributes of C corporations and as well as S corporations that make these tax considerations differ slightly for each. So, beyond, I think, what we're going to talk about today, should you have any specific questions, feel free to reach out for us. Understand, though, that preferential tax deferral is only for C corporations, and 30% must be purchased at that initial tranche there. Tax incentives related to the ESOP, non-taxable income related to stock for S corporations. Since an S corp is a pass-through entity, an ESOP as a qualified retirement plan has no federal income tax liability. Participants will pay income tax upon distribution, as I just said. But S corporations that are 100% owned by an ESOP will not be paying any federal income tax. So the point that just want to make here quickly before I turn this over to Brad to bring us home, if you look at a C corporation and an otherwise identical S corporation, the main difference here when we talk about income and cash flow at the end of the day is that line for federal income tax. On $1 million of pre-tax income, there's 21% as of now going out to the federal government. So you can see there just the enormous impact that an S corporation would have to the recurring cash flow of a privately held business. With that, we have one more poll. How many sessions do you guys plan to attend? Okay. Let's see what we have here. Oh, it left. I believe it was 100% that said all 8, Mary Lou, but I wouldn't be too sure. I'm going to turn things over to Brad now.
All right, we're going to bring it home just by talking a little bit about some valuation considerations as it relates to ESOPs. Now, ESOPs need to be valued for 2 specific reasons. It's either in conjunction with that initial ESOP transaction, whenever the ESOP is buying the shares of stock, but then also they're required to be valued at least annually in order to help with the administration of the plan. So the ESOP trustees or fiduciaries need to appoint evaluators that are qualified, independent, and meet the requirements of IRS and ERISA. Now, what they say is you need to engage a professional that regularly engages in valuation of business interests. Now, it is even more important for that initial ESOP transaction that it's somebody that has experience, because the DOL has come out and said that the primary issue that they see with the ESOP transactions is valuation. They've actually been quoted to say issues 1 through 4 are valuation, 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 and valuation. So it is an issue in terms of making sure the professionals involved are qualified and do it routinely. Now, in terms of talking about some of the valuation fundamentals, these are fundamentals that are considered in every valuation, but as it relates to ESOPs is what we're going to touch on briefly. Identification of the valuation subject. For ESOP valuations, it's either going to be the shares of stock that are held by the plan, if we're doing the valuation for administration purposes on an annual basis, or it's going to be that block of stock that is being purchased by the plan in setting up the ESOP or doing a staged transaction. The levels of value are important because it relates to the ownership characteristics of that block of stock itself, and specifically the liquidity and the ownership characteristics of that block of stock. So as it relates to ownership, is it a controlling or non-controlling ownership, and what discounts are related to that? As it relates to liquidity, it's unique in terms of ESOPs because when you look at an otherwise equivalent privately held business, there's a significant lack of liquidity. A privately held business is very difficult to turn into cash easily, whereas with an ESOP, they do have that put feature which allows for participants to convert their ownership into cash. Now, standard of value here is critical. We've mentioned it a few different times. The DOL rules and ERISA state that the standard of value is adequate consideration. Even though it's uniquely named, it is not a unique standard of value. It is equivalent to fair market value. Anybody that has heard Melissa and I talk about valuation has heard us discuss the standard of value. It is that hypothetical transaction price between willing buyer, willing seller, neither under any compulsion, all knowledgeable of relevant facts. So again, even though it's uniquely named, the concept of adequate consideration is by no means a unique concept. The premise of value is it relates to the circumstances in which the presumed transaction is going to take place. And with this one, generally ESOPs are going to be involving sponsor companies that are ongoing, profitable operating companies. So the premise of value is almost always going to be a going concern premise of value. The entity will be valued in continued use, with the value being placed upon it based on the expected future benefits that those owners are going to receive as a result of the ongoing operations and profitability of the business in the future. The valuation date is the effective date of any valuation. So putting it in back to our two buckets for why an ESOP needs valued, either a transaction or for administration purposes, that as of date for the transaction is going to be as close to or on the transaction date. If it's not exactly the transaction date, it'll be an opinion of value wherein procedures are then applied to bring that value current to the transaction date so that the trustee is able to negotiate the purchase of that ESOP that is not in excess of fair market value or adequate consideration. And then for administration purposes, the plan documents are going to say when that date of valuation needs to be. Generally, it's annually in conjunction with the fiscal year end of the sponsor company for cleanliness of financial statements. Now, a few things that are a little bit more unique to ESOPs. It requires valuation professionals to analyze the forecast provided by management of the sponsor company. That's extremely critical when it comes to ESOP transactions, because if you think about it, the selling shareholders are generally going to be management of the company, if not, a high-level management. They are going to be providing the projections, which provide the basis for the expectation of future cash flow of the business, which provide the value of the company. So the DOL requires that those forecasts be heavily scrutinized because a selling shareholder has some eagerness to want the highest potential sales price. So they don't want any inflated forecast and make sure that the valuation professional specifically analyze those. Evaluator has to consider all the approaches, but whenever we look at a profitable operating company, it's generally going to be an income approach and a market approach that are going to drive the value of the business. And then again, in terms of putting together a determination of fairness to the ESOP, the evaluator is going to perform an analysis of the transaction to determine that sponsor company's ability to service the debt associated with funding the ESOP purchase. And finally, in conjunction specifically with ESOP transactions, the evaluator is asked to provide a fairness opinion. And what that fairness opinion really is going to do is going to say a few things. First of all, that the transaction is not greater than fair market value, that fair market value determined in that independent valuation of the business, the reasonableness of the interest rates, so making sure that the interest rates are market-based and provide a fair expense to the sponsor company, to the ESOP, and that overall the terms of that transaction are fair and reasonable to the ESOP from a financial point of view. So with that overview, I'm going to hand it off to Melissa to bring us home.
Thanks, Brad. Just a couple of closing comments. I know we have a minute or so left, but I hope you can glean from the presentation, and I understand it was pretty brief, but ESOPs do provide many tax and economic benefits to companies' owners and employees. You know, in a climate here where everybody is looking to hire employees to maintain or retain them, employee stock ownership plans are a good way to do that. Also, it promotes a culture of employee ownership where you'll see value starting to maximize. The use of an ESOP, based on the history and some of the things that I talked about, use of an ESOP should not be dismissed out of hand. There must be proper education, and definitely engage in feasibility if you're thinking about an ESOP as an exit planning strategy, because that's where the tires are going to be kicked to see if in fact it's feasible for a company to undertake or install an employee stock ownership plan. And certainly the value that is provided through tax savings more than certainly justifies the cost to implement and administer an ESOP. Thank you so much for your time and attention. I know that this was very quick today. Our information is up on the screen. You can find us on the website. Please feel free to reach out. ESOPs are something that we're very passionate about, love serving our ESOP clients involved in those transactions. So feel free to reach out to either one of us. Thank you so much.
Okay, I